Kalshi is doubling down on commodities at a moment when inflation hedges and headline risk are reshaping portfolios. A dedicated hub promises faster access, clearer pricing, and new product lines that invite both institutions and individual traders into the same arena. In plain terms, this matters because raw materials like oil, copper, and grains now sit at the center of risk management and speculation alike. The move signals a shift from niche experiments to scalable marketplaces, leveraging existing exchange muscle while expanding the transparency that users say they crave during uncertain macro cycles. Investors watch for liquidity, timing, and regulatory clarity. As a barometer, Kalshi is adding a broader suite of commodity binary options and futures-themed contracts paired with a dedicated hub that centralizes product launches, liquidity incentives, and educational tools. In practice, traders will see more contracts tied to energy metals and ags priced through a transparent order book with risk controls designed for retail access, yet robust enough for institutions. The expansion is not about creating a new exchange from scratch, but about layering commodities on top of Kalshi's existing platform to improve pricing discovery, volatility tracking, and predictable settlement processes. In markets that have long lived in over-the-counter shadows, commodity markets have long oscillated between OTC darkness and public price discovery. Kalshi began as a platform offering binary bets on events, leaning into the same crowd seeking transparent, rule-driven outcomes. In recent years, regulators clarified that listed event contracts could coexist with traditional futures, opening room for new risk transfers. The expansion to commodities taps a broader trend. Investors craving hedges against supply shocks, and policymakers nudging digital trading venues toward openness. Past efforts by exchanges to tokenize risk-faced liquidity and regulatory headwinds, yet the current environment favors platforms that merge straightforward products with credible settlement standards. Initial signals from traders show a rush toward more granular commodity exposure, with open interest rising in risk on contracts tied to Brent crude, copper, corn, and cotton. The prospect of a dedicated hub tends to compress spreads as more market participants compete for price discovery on Kalshi's platform. Brokers report rising volume in calendar spreads and event-linked questions around whether the hub will attract new liquidity or divert it from established futures venues. Analysts note that the expansion could slow roll into ETF variants, correlation studies, and hedging programs that portfolio managers use to temper volatility across global markets. Risk teams at commodity majors and industrials are watching the launch closely, as a new venue for hedging price risk could alter how they manage cash flow exposure. Producers, refiners, agribusinesses, and mining outfits may find hedges that better align with production cycles, while banks and asset managers explore structured bets that blend traditional futures with binary outcomes. Retail traders could gain simpler access, but they must learn new settlement conventions and rules. Exchanges, clearinghouses, and data vendors will also experience higher demand for risk analytics, pricing feeds, and transparent settlement histories to support wider participation across global markets today. Macro forces frame this initiative. Inflation dynamics, energy security concerns, and supply chain fragility push investors toward hedges and more visible risk transfer. Chinese and European demand shifts, US sanctions chatter, and currency volatility all feed into commodity volatility in real time. Kalshi's move aligns with a broader push by exchanges to tokenize risk and provide on-chain style transparency without sacrificing traditional clearing safeguards. The policy backdrop, central banks balancing inflation with growth, and regulators weighing consumer protection against innovation creates a cautious environment where new products must demonstrate credible settlement, robust liquidity, and defensible price formation across global commodity markets. Smart money is testing the waters, with hedge funds and asset managers penning pilots that mix commodity options with directional bets. Some institutions are praising the hub for improving liquidity signals and execution certainty, while others remain cautious about onboarding costs and learning curves. Retail interest tends to rise when transparent settlement lowers fear of mispricing, yet education and risk controls must keep pace. Data providers report faster streaming quotes and more granular trade metadata. Across the board, the consensus is evolving toward more evidence that traditional hedges can live alongside digital, rule-based markets. Investors seek proven track records. Every debut comes with pitfalls. The biggest bear case is illiquidity during stress, if new contracts fail to attract sustained participation, leading to wider bid-ask spreads and price dislocations. Regulatory uncertainty, if tightened, could slow enforcement timelines or cap product scope, undermining credibility. Model risk sits at the heart of binary-style contracts that rely on accurate settlement oracles. A misstep could trigger cascading adjustments. Operational outages, cyber attacks, or data delays would erode trust quickly. Finally, competition from established futures venues may force Kalshi to trade off margins in pursuit of growth, creating inherently fragile long-term incentives too. For retail players, the first move is education and risk budgeting. Treat binary commodity bets like a spice in a diversified diet, not a single course. Start with small allocations, study settlement rules, and use demo accounts before committing real funds. Focus on hedges that align with your production or consumption needs, such as fuel price risk or crop price exposure, rather than chasing flashy new products. Monitor liquidity indicators, watch for systematic biases, and insist on transparent pricing data. Combine Kalshi-style tools with traditional research to avoid over-concentration in any one theme. Be patient, diversify, and measure outcomes. Looking ahead, Kalshi's Commodities Hub could redefine how risk is priced and traded over decades, especially if liquidity compounds and new partnerships materialize with banks, brokers, and data firms. The expansion may spark cross-asset strategies that blend binary bets with traditional hedges, creating more resilient portfolios during inflation shocks. Yet adoption hinges on clarity, reliability, and ongoing education. If the platform delivers on settlement integrity and low frictions, expect steady outperformance versus venues in select contracts. For viewers tracking inflation supply chains and policy shifts, this is a development worth watching daily. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.